Dustin Timmons, financial advisor with Jazz Wealth Managers, and I'm going to read from a sheet today because one of our customers, Benjamin W., sent me an article. And I thought this was the coolest article ever. I never had even thought of this, but I want you guys to consider something, and I'm going to tell you a story while I read from this article, so I hope you're ready. Now, the first thing I want you to consider is the markets recover 100% of every decline ever in history. Remember that. If that's the only thing you learn from me, remember that when the markets fall, they always recover. 100% of the time. It's not my opinion, it is pure fact. And if you know that, then you would never ever have to be scared of the markets as long as you're invested correctly. All right, well, this article comes from Ben Carlson. The blog is called A Wealth of Common Sense. This was written a couple years ago. And again, thanks to Benjamin W., one of our customers, for sending this to me. It is called, What If You Invested Only at the Very Top of Every Market? How would you end up? So he tells a story. So we're going back to 1970, and we're using a fictitious investor named Bob. And in 1970, Bob says, I'm 22 years old, I need to start investing for retirement. So he says, I'm going to save $2,000 a year, and then each decade I'm going to add $2,000. So in the 70s, he's going to have $2,000 a year that he's saving up. In the 80s, of course, he's going to have $4,000, and so on and so on. He's going to do this until he retires. Now, Bob is going to save the money and choose the time that he wants to put it into the market. He's not going to dollar cost average, which we'll get to in a second. So Bob starts in 1972. He's got $6,000 total to invest. That's his starting balance with his investments. Now, he waits until right before 1973. He invests in the stock market. We'll call it the S&P 500. And what happens there, if you're familiar, if you're old enough to remember that, the markets crashed. 50% loss, just like that. Old Bob put his money in at the absolute high, and the markets fell 50%. Bob, he hung in there, right? He's like, okay, that's fine. I'm in the markets. I'm going to go back to saving my money, not investing, and wait for the markets to recover. Well, Bob kept saving up just as his plan was in a bank account. He waited 15 years until 1987, right before the crash of 1987. By then, he had saved up $46,000 and he was ready to invest. He puts his money in literally right before the 30% crash this time. So Bob just went through a 50% crash. He let the money stay there, saved in a bank account, let it grow, 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 grow. 1987, he says, you know what? Things look good again. I'm going to put my now $46,000 in there. In 1987, he loses 30% right off the top. Well, same thing happens. Bob says, I'm going to keep saving my money in my bank account. He waits all those years until 1999. Now he's saved up a total of $68,000. He goes, you know what? This market is hot. I'm going to put my money in the market now, buy here at the very, very top. And you know what? In December of 1999, the markets fell 50%. And over the next 3 years, they fell 50%. So Bob just simply can't catch a break. He keeps investing at the absolute high. But so far, he started with $6,000. He was wrong about his timing. He put in $46,000 15 years later. He put in $68,000 in 1999. And now, oh, Bob is just psychologically damaged, right? I mean, obviously, if you bought right before the high of every single market, you'd be pretty frustrated, right? So Bob says, all right, I'm going to keep saving up my money. In October of 2007, he's got another $64,000 he buys right before the financial crisis that just rocked the whole United States, just around the world, really. The markets fell 50%. Poor Bob, just can't catch a break. So Bob says, you know what, I'm going to keep saving my money. I'm not going to invest anymore. He saves up $40,000 according to his plan. He said how he was going to save his money, but he could never really time the market. So here's the thing. Right now in the stock market, most people feel like we're at a high. I get a lot of questions from people that say, I don't want to buy at the high. Dustin, I want you to wait until the markets fall, and then I want to buy when the markets fall. So this article really struck home with me because a lot of you are sitting around waiting for the markets to fall, but you're missing out on every little bit that the market's been giving you here. So how did Bob fare after a whole lifetime of saving and investing at the absolute worst possible time? Well, all in all, Bob ended up investing a total of $184,000 into the market. We'll show the chart over here, but he still has the $40,000 in the bank because he was scared to invest that. What did that grow to? Well, total that grew to $1.1 million by his retirement age of 2013 when he turned 65. So even though he puts $184,000 in, buys at the absolute possible worst times, he ends up with $1 million. That is the power of compound interest. Now, what if Bob would have dollar cost averaged the whole way? Rather than save in a bank account, then invest it when he thought was right, what if he just consistently put that money in the markets? We tell our customers all the time, whatever you normally would invest for the year or for the month, break it down into really small weekly contributions so you can dollar cost average no matter what the markets do. Doesn't matter to us. We don't charge you any more for that. We'll take care of it. But what if Bob would have dollar cost averaged? Even through all the ups and downs and didn't try to time the market, he would have actually ended up with over $2.3 million despite buying most at the very, very highest possible prices. If he would have bought during the dips, bought during the rallies, and just said, forget it, I can't time the market, he would have ended up with $2.3 million. So the lesson here is you will experience losses. If you have been waiting to start retirement investing, I hope you'll consider us at Jazz Wealth, but the bottom line is these things will happen. You will buy and see your account lose in value. You gotta know that just like Bob, in the long run, you're going to be just fine. If you happen to buy tomorrow, and tomorrow is the absolute high of the market, it doesn't matter. Also remember that the markets recover 100% of every decline ever in history 100% of the time. Well, I hope you enjoyed that. Look, to follow up on this video, click over here. I'll show you how to take fear completely out of the markets and investing. It's basically some of the stuff that we've been saying here in this video. But if you like what we have here today, go up here and click subscribe on our logo. Really helps us out a lot. Thank you so much for those of you that have already done so.